Okay. Good morning, everyone. Happy Tuesday, right? We're right here getting ready to finish up January. And there's a lot of moves that have happened in the last 7 days as it relates to real estate. So if you remember, when we spoke last week, I told you guys a couple things. I said, look, we talked a little, we obviously did the market update, and then we talked a little bit about what was happening out in the world as it relates to real estate. And I made a comment that no matter what, things could move very, very quickly over the next couple of weeks, because what, with new administration comes new rules. So we're going to talk about a lot of the stuff that has happened over the last week as it relates to real estate, right after we go through the market update, including news that happened as of yesterday, right? So this is going to be really important. Some of it is going to be things that we talk about that are happening or occurring at a little bit more of that federal level. And then we're also going to be talking about a couple things that happened uh, this literally Monday, right? Is there's a lot of stuff going on. We're going to keep on going with those updates. Just remember, this is going to be really important information to share with your clients. With that, I'm going to go ahead and share my screen so that we can go straight into the market update. And then from there, we're going to move into just some industry news. So I am going to go through our market update a little bit quicker than usual today. Let's see. Uh-oh, you guys see yourselves, don't you? Okay, give me 1 second. Let me make sure that the slides are showing, my friends. Uh-oh, what did I do? Technical difficulties, everybody. Give me 1 sec while I just pull up those slides. Oh, unless it looks like I closed them. Okay, got it. Let me open those up again real quick. All right, guys, thank you for bearing. Tech happens, right? Tech happens. So let me get into, we're going to go ahead and screen share. And I am loading. Okay, everybody see the slides okay now? Awesome. Thank you guys for bearing with me on that little tech hiccup really quickly while there we go. Everything's kind of loading brand new. All right, let's go ahead and jump right in. So a couple things, we've been watching Showing Time. I'm going to be leaving this particular slide on here for us as a reference point because it's going to provide kind of that baseline, and Showing Time is leaving it as well. We talked a little bit about how this looks a little different this year, is where we're really going to see kind of what our bases, if showings kind of continue to rise, or if we're recovered, are we going to see kind of those ups and valleys and those hiccups that we saw in 2020. Again, we know 2020, we saw the major dips because of the pandemic, and then we saw this pent up demand kind of rise. Now we are establishing a bit of a baseline, right? So you can see right here that as we look at the showings that are specifically for 2021, we're seeing a little bit more consistency so far in what 2019 looked like, right? As well as the beginning of 2020 before the pandemic. So this is just going to be something that we kind of continue to watch and continue to monitor. We're not seeing a major spike in showings. We're not seeing a major decrease. We are seeing a little bit of an increase as we get here later in January, which is pretty typical of this time of year. So it's really looking a bit more like a year like any other affected by seasonality versus last year where we had all these peaks and valleys with the pandemic. Of course, I know that out there, as you guys are out looking at properties, you're still seeing a lot of competition. Your clients are still seeing more properties than maybe they had than they had, before. Because of that competition, they might, instead of seeing 5 or 6 properties, or even 2 or 3 properties, right? If you got your clients writing offers really early on before, Now you might be forced into seeing a lot more properties as your offers, you kind of face those competitive offers, and your offers are being declined, or looking at additional properties through there. So we'll keep an eye on this, but right now it's looking a lot more akin to what usually happens at this time of year. No anomalies so far. Now, of course, with some of the new orders that were rescinded in California literally yesterday, by our state, we may see showings pick up again, but that could have an impact here as well. Although in reality, it doesn't actually affect us in the real estate market, because we're essential business, and so our restrictions have pretty much stayed the same throughout. It does affect the perception of the clients. And so you may have some clients that had kind of stopped and are looking at getting back in. I see a hand went up. Jennifer, do you want to come off mute?
Hey, everybody. Good morning. Happy Tuesday. Monica, I just wanted to throw in there that probably a reason why our showings are down is really there's a direct correlation with the inventory. We have a plethora of clients that there's nothing to show them, so we're just kind of waiting for something new to come on the market. So I think inventory has a huge plays a huge role in why that the showing numbers are down. There really isn't anything to show our clients.
Yes. And one thing to note on this, right, on it, is the showings are not necessarily down significantly. This is where I do want to give you guys a point of what we look at from baseline. It's going to be a change from the first week of the year, right? So just if you kind of take a look right over here where we were up a little bit more significantly towards the end of December, you guys can see that right here. This is that baseline that's kind of feeding out of that line. So, sorry guys, I jumped in a little bit, but yes, absolutely. Inventory is a major issue that we're seeing right now in the market. And we're going to talk about that as we start looking at the 4 counties as well. All right, so going really quickly into Los Angeles County, our under contract, the average price point is $679,000. The median sold price is $675,000, and that new price is $698,000. Again, not much of a fluctuation week over week in terms of pricing of new inventory, or really in either 3 of these categories. We're not seeing a huge fluctuation. If we look at the trends though, and we're looking at this 12 weeks compared to the 12 to 24 weeks prior, this is where we see that our under contract has gone up about 1.3%. That accounts for a median price difference of about a little over $8,000, right? Sold is only up about 0.1%. That's literally less than $5,000 across the board. And new inventory, right? New inventory pricing is down about 0.2%, which is about a little less than $1,450, right? This, again, we want to keep in mind that we are not seeing prices trend significantly upward, which is important when you're putting new inventory on the market. Now, again, limited inventory. So while there is that demand, we're not seeing this reflected in the pricing of new inventory getting on the market. Where we're seeing that increase in price reflected is in the under contract price point, right? That's where we're seeing the highest spread. And that, of course, has to do with the multiple offers that we're seeing in the market. Now, looking at inventory, right? Looking at inventory, we've been looking at this pretty significantly and watching what this looks like when we see the trends over the last couple of weeks. Now, if you guys recall, what we've been looking at is for a couple of our counties starting in September 28th, and then for 2 of the counties, it starts October 5th, is where we started seeing a decline in this red bar, which is our new inventory. Of course, we saw a bigger dip as we got into Thanksgiving, and then we saw again a bigger dip as we got into Christmas. At the beginning of the year, we saw a little bit of this recovery right here. It was even over the last week, and now we've seen a little bit of a dip again. So what does that mean, right? What are we looking at here? Now, what happens is a lot of people that were like, I'm waiting I'm waiting until the end of the year. They get really excited and they list in those first weeks of January and they're ready to go. Now we've seen a little bit of that slowdown again as we start getting into mid January. That doesn't mean that there's not still inventory to put out there or to get on the market. But again, we're definitely seeing that slowdown of inventory again. A couple things right here as well. One of the conversations you want to be having with your sellers. So if there's low inventory on the market and they are planning on selling their house with the intention of buying something else, the struggle that they're coming into is what? There's nothing for them to buy, right? There's nothing for them to buy. And so all of a sudden they're in this position where they're not sure if they want to just wait until they find something else, and yet they need the sale of their home to qualify for that next property. A couple things that we're seeing on the market a lot right now is contingency for replacement home. You want to make sure that you're having that conversation with your clients, that they can absolutely list their home on the market with it being contingent on them finding a replacement property with the potential of them closing concurrently. Of course, that is a little bit, it can be a little challenging to manage because you're dealing with multiple parties and multiple transactions at the same time. And yet that's going to help your sellers kind of have a little bit more confidence in entering the market if they know they're not necessarily going to need to close on their sale until they find a replacement home. And in reality, the buyers are willing to deal with that because the buyers really want property right now, because we're seeing this low inventory kind of throughout the market right now. So to put that inventory in perspective, our under contract, there was this one, it was pretty similar to what we saw last week. There was 1,125 homes that went under contract in Los Angeles County last week. 859 homes sold in Los Angeles County last week. That actually declined. And I know a couple of the things that we're seeing across the board, we are seeing extension of that under contract time period with more challenges that are coming up within the transactions, whether it's things that are being flagged at underwriting, flagged during the appraisal, flagged during the inspection, additional repairs that the lenders are asking to have done. Are definitely things that are coming up, things that we don't always traditionally see, right? So to give you guys an example, we had one transaction where there was a foundation issue that was flagged during underwriting that wasn't even flagged during the initial inspection that then delayed that transaction, right? So these are things that can come up because the underwriters are really looking at a little bit more to make sure that it's going to be a quality investment. They want to make sure that it's a safe investment for them, right? That's their job, is to protect the financial institution. Now, the other thing that happens here is, like I mentioned, that we're seeing more of these contingent offers. So we see a decrease a little bit in sold property, not because there's not property going under contract, because obviously that number is a little bit higher, right? But those escrows again are getting extended. And then new inventory, 1,018 properties. That was a dip from last week. And so we want to continue to monitor this. Overall, we're down in the past 12 weeks compared to the 12 to 24 weeks prior in every single category, down 17.9% in under contract, down 5.4% in sold property, and down 33.2% in new inventory. Moving over to Orange County, right? Moving over to Orange County, our median under contract price. So again, we see a little bit of a dip in terms of the under contract price, where we saw a little bit of an increase these first couple weeks of the year right here. We see this dip back, but everything else is pretty even across the board. Our median under contract price was $800,000, sold price was $805,000, and new inventory $815. The one thing I do want to point out here, you see this new inventory, it actually went up a little bit, right, in terms of pricing. So this is a little bit unusual because Orange County is a higher price point area. We don't always see the significant price increase happen in a higher price point area. So this is just going to be something that we want to continue to monitor. Again, 1 week does not make a trend, but it is something for us to look at. Now, if we look at these last 12 weeks compared to the 12 to 24 weeks prior, we can see that we are up price-wise across the board in all three. 3.3% in under contract. Because this is a higher price point, that's going to deal with a higher number here, right? So to put that in perspective, that's $25,000, meaning that we are trending up an under contract pricing $25,000 more on a week over week average than we were at this same time 12 to 24 weeks ago, right? So you may be seeing that competition is a little bit more fierce in those desirable Orange County areas as well. And we're seeing those higher offers on the table. Sold price up 0.6%. That accounts for about $5,000. And our new inventory is up 0.6%. Again, that's about $4,000, a little bit over $4,500. So a little bit of a price increase across the board. Again, not super significant. The biggest significant jump that we have is under contract, which is because of what happens when we're in a multiple offer situation as well. Looking at the inventory, again, a dip in new inventory week over week. So we saw, again, those first 2 weeks of January where people were saying, yes, yes, yes. All those people that said, let me wait, were listing their home right away. Now we're dealing with the ones that have a little bit more of an objection. And so we want to make sure that we're still having those conversations with them, where we're reassuring them on kind of what's going on as well. Under contract, 704 homes went under contract in Orange County last week, 520 homes sold, a dip from the previous week again, and then 501 homes were listed on the market, a more significant decrease here as we look at this kind of spread. Overall, as we're looking at so you can see in the last 12 weeks, there's been a lot of fluctuation here in Orange County as well, where we can see the numbers were just higher in the fourth quarter, a little bit more similar to what we tend to see a little bit in that first quarter of the year. The last 12 to 24 weeks, when we look at this, that end of the fourth quarter, that was actually a little bit of the anomaly, right? A little bit of that pent up demand that we saw. So overall, under contract is down about 194 homes week over week, right? Which is a 24.8% decrease, 16.5% decrease in sold inventory, which accounts for about 131 properties week over week. And then new inventory down 38.5%, meaning we're down a little bit less than 350 properties a week on average, right? So important to keep in mind here. Now looking at Riverside, right? Riverside, we're trending up in price, right? We're trending up in price. So this is going to be something to keep an eye on. Again, that spread is not huge. What we are going to look at that's a little bit different in Riverside that we'll talk about is this sold price, right? So under contract, we're seeing that the median price was $450,000, our median sold price $430,000, and our median new price $435,000 in this last week. A little bit of a dip in our sold and our new week over week, but again, 1 week doesn't make a trend. Now, as we look at the past 12 weeks compared to the 12 to 24 weeks prior, we are seeing that under contract pricing is up 1.6%. That accounts for about $6,789 week over week, right? So that's the week, that's about the difference in the 12-week prior when we look at that average. Sold 3.7%. So this is interesting because in most of the cases, what we're looking at is we're seeing a higher spread when we're looking at under contract. In Riverside, we're seeing the higher spread on sold. That's going to be reflective on what was happening 30, 45, 90 days ago in under contract, right? So we're seeing that higher spread with about a difference of $15,930. This means that we're not seeing that huge spread in terms of under contract inventory right now. So the multiple offers that are happening now might be a little bit more conservative than they were 12 weeks ago, right? Where we saw a little bit more of these dips, these increases here in under contract that are now had an effect on increasing that sold price. And then new inventory, right? New inventory pricing is up about 0.3%. That's only a difference of less than 1,500, right? That's $1,457 week over week. Again, not a major increase here. So you want to make sure that you're pricing strategically to get, not that you're not going to get exposure right now, you're going to get a ton of exposure right now, but you still want to make sure that you're pricing strategically to keep your seller in control on those multiple offer scenarios as well. Now, looking at the inventory, Riverside has also been all over the place, but we know that part of this is due to some of the holidays, right? We've got Thanksgiving that happened right here. We've got Christmas and New Year's that happened right here. We saw the increase. So now that we're looking at 3 different counties, now we can start calling this a trend, right? Where we saw a decrease for Christmas, we saw an increase right at the new year, the first 2 weeks of the new year, and then we see new inventory dip back down. Now across all 3 counties, Los Angeles, Orange, and Riverside, we're seeing that same trend. Overall in Riverside County, 587 homes went under contract this past week, a little bit of an increase from the week prior. Sold inventory also down, right? 444 homes sold within the last week. And with new inventory, 495 homes listed on the market in Riverside County last week. Overall, we're down and under contract 18.3%. In sold, down 12.6%. And in new inventory, still the highest spread, 31.5%. Now, let's take a look at San Bernardino County. San Bernardino County is interesting as well when we're looking at the trends from a pricing perspective over here. So San Bernardino County, which is our lowest priced county, under contract properties entered at 395,000, sold inventory at 405, and new inventory entering the market at about 400,000. Now, when we see this little bit again, so when we're in a lower price point, those percentages account for less money. So I want you guys to keep that in mind as well. When we look at a 0.2% decrease in terms of under contract, that's going to account for $683, literally $683, right? Week over week. So not too big here. But what we're seeing very likely right here is that we're not seeing as significant of these offers coming in. They might not be as significant of a spread, but again, it's because the percentages are a little bit lower, right? Lower price point percentages are a little bit lower, so it accounts for less dollars here. What I would really recommend in San Bernardino County is that you are making sure that if you are bidding higher on a particular property, you're going to want to make sure that you are doing the comparables, right? You want to make sure that you're doing the comparables to make sure you're not going to have issues with appraisal. I can see this when we're looking at these lower price properties as well. We also see in some of these areas, we're going to see more manufactured homes, more of that lower price point, and more things that have the potential to get called out when we start looking at appraisals and underwriting. Sold price also, so this is interesting as well, because we're seeing this in Riverside County and in San Bernardino County, our 2 lower price categories, that our sold price is where we see the increase, 2.1%. That accounts for about $8,000 week over week. And then new inventory, new pricing down 2.4%, which accounts for about $9,466, which means San Bernardino County prices are not going up significantly. They are going up if we look at just slightly right here the last couple of weeks. But if we look at the last 12 weeks, we are not seeing prices go up in San Bernardino County when we're looking at the averages. So again, when you're pricing, right, we want to price ahead of the market. If we are not trending upward Do not look at a comparable and say, oh, well, this one is priced at 350, so we're going to price ours at 370, right? Don't do that in this county, because the trends are not going to support it, right? They're not going to support it. And a lot of times we look at the inventory, we're like, hey, inventory is down, so I can overprice a property because it's going to support it. It just means your property is going to sit on the market a little bit longer than somebody else's might, right? And you may have to drop the price anyways, right? Now, can you still get an offer? Sure. Is your seller going to have as much control if you have less offers? No. So we always want to keep that in mind as well. When we look at our inventory, right? When we look at the inventory trends. So again, the same trend that we're seeing, where we saw a little bit of an uptick at the beginning of January in our new inventory, and we saw that decrease this past week. 530 homes went under contract in San Bernardino County this past week. We see 444 homes sold and 500 homes sold in homes listed on the market within San Bernardino County this past week. Overall, we're looking at the spread here, under contract down 17.4%. Again, I want you guys to remember that when we see lower percentages, the numbers account for a smaller number, but it's still a large percentage. So that's about 98 homes down under contract week over week though. Sold down 11.1%. That's about 63 homes week over week. And then new inventory down at 30.3% week over week as well. There was a great question that just came up, which is, will it be supported in Los Angeles County? I'm assuming that's in relation to what we're saying on price. So let's go ahead and we're gonna dip back to LA County on our pricing trends, right? So pricing trends right here, we can see that trend wise, while we saw a little bit of an increase within the last couple of weeks from a price perspective, right? A little bit of an increase the last couple of weeks from a price perspective, overall, the trend is down 0.2% in the last 12 weeks compared to the 12 to 24 weeks prior. What does that really mean when we're talking with our sellers? I would not recommend, even though I know we have limited inventory. Now, you want to look at the inventory, you want to look at what you're pricing, you want to be really discerning about this. Of course, if you have an extremely competitive property, the property is turnkey, it's in great condition, right? It's kind of that bread and butter, super desirable property at a great price point, and it's priced a little bit higher. Will the market support the price? Well, we are in a high competition, low inventory market, so it might, right? It might. But the trend is not that the prices are being supported based on what they're being listed at, right? Where we're seeing the highest price increases is here under contract, right? Under contract. So strategically pricing a property means that we price it either at market or a little bit under market, because what happens right now, we've honestly trained a lot of our buyers to do what? Look at prices that are a little bit lower than what they're willing to bid up at, and then they're overbidding on property. To put it in perspective, I was talking to one of our associates yesterday. They have a great property in Los Angeles County. Of course, they priced it strategically, and now they have 22 offers on it, right? Now, flip on the other side, where we have a property that maybe was priced a little bit higher, and we have 3 to 4 offers on it. Both are great, right? 3 to 4 offers is still a great amount of offers, but who has more control in that scenario? It's the person with 22 offers, right? Because now they can do a seller multiple counter offer with more competition. The seller really has control over not just what they want in terms of price, but what they want in terms of the terms. And we know terms are also very important right now, especially as we're seeing more and more people wanting to do some type of contingent sale because of the limited inventory. So what happens if all of a sudden, and what's interesting is that property that has the 4 offers, that property is also a contingent sale, meaning that that particular homeowner needs to go and find their replacement property. What happens is if in that search of them finding their replacement offer, all of a sudden those 4 offers that they had or whatever offer they accepted Now, all of a sudden people start getting impatient. They find something else that maybe is not contingent and they rescind their offer. Now we have less backups to choose from than the original property with 22, that still both of them can sell a lot higher, but we know that when we price strategically, that's going to give us the best opportunity to control that for the client. So great question about Los Angeles County. Great piece to keep in mind. Now, I know we're right at that half-hour mark, and I realize, you guys, we've been going over time-wise the last couple weeks, but there is so much stuff that is incredibly important because of what happened last week. So obviously, we had the inauguration last week. We got a new administration, and a lot of things moved very, very quickly. I do want to note a couple things that I want to mention on here. One, there's a new chief of staff for HUD, right? Which is Jen Jones. HUD also declared that FHA is once again backing DACA loans, right? It's once again backing DACA loans. Now, that's going to be really important for your clients that maybe were not sure if they were going to be if they were going to have that opportunity. They kind of had that rescinded. Now that's back. A couple things that you want to make sure that remain in effect. The property has to be the borrower's principal residence. They have to have a valid, they have to have a valid social security number, except for if they're employed by the World Bank, a foreign embassy, or some type of equivalent. They have to be eligible to work in the U.S., and they satisfy the same requirements, terms, and conditions as those for U.S. citizens. This is going to be really important. If you had any clients that were affected when that was originally rescinded, you want to make sure that you're having those conversations with them now, that they have the opportunity to once again qualify FHA. The other thing that's going to be really important. So as of last week, the federal eviction moratorium was set to expire as of January 31st, right? As well as the foreclosure moratorium. Biden, by executive order, extended that through March 31st, right? So federally, we have an eviction and foreclosure moratorium that extends through March 31st, which was really important. This changed yesterday specifically for California. Okay, specifically for California, yesterday, there was an additional plan put in place by Governor Newsom and legislative leaders, which is to extend the eviction moratorium through June 2021. So I don't want you to get confused, because obviously we talked about this, and I posted it and I shared that last week, that we had a moratorium that had extended through March. That moratorium for eviction specifically in California is now June, right? So that's now June 30th, 2021. Now, a couple things that are going to be important on this. There's a lot more to this bill than just that moratorium being extended, right? There is also, so the plan that extends that, what it's also going to do, right? What it's also going to do, so it affects those that could not pay their rent between March and August because of the coronavirus pandemic, or those that have been able to pay at least 25%. That was the original moratorium that California had, that's now been extended. What it can also do is use federal money to pay up to 80% of some tenants' unpaid rent, right? So this is going to have to do, there's going to be like a prioritization for this relief program. Basically, it's going to be like a rental subsidy. And what happens is, so the low-income renters have to be within 50% of their area's median income. And those that have a stronger payback background are going to be prioritized for this relief program. The other thing that this particular piece has is these rental subsidies. They have to be paid. They're going to be paid to landlords who agree to forgive 20% of the unpaid rental debts, or it could cover up to 25% of late payments for landlords that don't wish to participate. What I want you guys to understand here, so there's the pros and cons on this. What's really big to understand on this is not something where all of a sudden, you know, everyone is going to be required to basically accept these subsidies. So this is still going to have to do with the landlords, right, agreeing to their portion of how they're going to contribute to this bill, and then the federal funds being used to pay them for that rent. There's a lot of conversation around this. It's still really early, but generally this could have an impact where even though they're in a moratorium for eviction, right, this is a little bit of the luck of the draw that the landlord is also willing to participate in this federal assistance program so that they can regain or recoup some of their losses. We could run into a scenario where some landlords that maybe don't want to participate because they're wanting to relocate the tenant after or flip the building right after may choose not to opt in. So of course, there's a lot of conversation around that. There's a lot of tenant advocacy groups that are advocating to kind of change that portion of the plan. I see a great question. Did the foreclosure moratorium get extended? Right now, no. Right now, what this is specifically for evictions, but I'm sure, so the eviction moratorium for California extended through June 30th, and then the foreclosure moratorium as of right now is through the end of March. That's a great question, and I just want you to keep in mind that could change, right? That could change. So just the way everything else continues to kind of change, this could change as well. So we'll keep an eye on this as well. The other thing to note, so I want you guys to realize that we are seeing a little bit of changes on the mortgage side as well, right? On the mortgage side as well. I see a hand raised. Jennifer, do you want to come off mute?
Yes. Hey, Monica, good morning. Quick question going back to the moratoriums on foreclosures and evictions. So I remember reading that the foreclosure moratorium, you know, like you mentioned, got extended to the end of March. But I noticed it also said it's only for government-backed loans. Is that still the case, or is that for all mortgages?
So when we look at that piece, so there was it was an executive order, and what it called on was the federal housing agencies to extend the moratorium for federally backed mortgages at least through March, right? We may still see some foreclosures happening on non-federally backed mortgages. This is really important for now, given if they're in forbearance, that's a little bit different, right? If somebody's still in forbearance and they still have time left on their forbearance, they can't just go foreclose on them. Okay. And so that's where there's kind of this important part, because even though this kind of moratorium was meant to expire, we may still see some extensions of forbearances, and we are seeing that right now. We may see some evictions, not evictions. We may still see some foreclosures and notice of default hit the market, because the order was designed as more of that federal piece with federal housing agencies. I will also look into that a little bit more though, but I know we are already seeing some notice of defaults kind of hitting the market with some of those other mortgages as well. Now, again, the forbearances, they are still required to allow if they offered the forbearance, that to continue. The forbearance is meant to last as long as a year, right? It's not designed for that, but it's meant to allow as long as a year. So if they initially went into some type of forbearance back in March, right, then they're pretty much almost extended through that end of March as well. We're also going to see a lot of people refinancing, right? We're seeing that piece as well. That's a really good question though, Jen. If you have clients that are not in a federally backed mortgage, right, that they were some type of conventional product, or they dealt with some type of other financial institution, or they have a second loan on their home or whatever that might be. You want to be having these conversations with your clients right now around what their options might be. Even with those that are in kind of, even though this extension is going through March federally on the federally backed loans, right now is the time to be having that conversation with the clients. Given, right? I've been saying that for 4, 5, 6 months, right? We've been saying that since March. So right now is the time to have the conversation. This is kind of like they say, the best time to plant a tree was 20 years ago. The second best time is right now, right? Is if you haven't had those conversations with your clients, you want to make sure that you are, hold up, I see a question in the chat box. You want to make sure that you are having those conversations with your clients about what their options are. I have a client, let's see, I have a client who has a second mortgage not federally backed that has a notice of trustee sale. Any programs out there that can assist them? That would be something I would honestly, I would talk to a lender. Are they, and I'm curious, are they currently employed, unemployed? Is that your client, Jennifer?
Yes.
Are they employed, unemployed? Did they regain employment?
Retired. She's retired.
Okay, they're retired. Oh, interesting.
Yeah,
Okay.
and she's current on her first. She's just in default on her second.
What is the what's the loan amount?
The second original loan amount was like for 44,000, but probably has gone up a bit because of lack of payment. So it's probably closer to like 55, 60.
I would talk to a lender to see what options they have. Right. Yeah, I would talk to a lender to see what options they have. I think that's going to be your best bet on it, to see if there's, so they may want to, what I would, she's retired, so I don't know how they would qualify on that. But in reality, what I would look at is if there's a way to cash out refi the first loan to pay off that second loan. Now I'm not a mortgage consultant, right? So I'm just kind of brainstorming, problem solving. But that would be something that if she's got equity from that first mortgage, then she might be able to use some of that equity to pay off that second mortgage. Right. And that way they get out of that second, they don't have that second anymore, and they have that first. This is really interesting. And the reason you actually brought up another point that is kind of really interesting that we've seen recently is, so I don't know how familiar you guys are. Some condos have, right, like the HOA. And we've seen in some cases where even though somebody may have equity, they have 2 loans on a property. Let's say there was some type of like, we've seen an HOA trigger on a second loan, right? Or different things happening where the second loan is triggering the foreclosure process so that they can essentially force the client to pay off that second loan with their first loan. That's what I would do, Jen, is I would definitely call any of your preferred lenders, right? And see if they could, use some of the equity, do some type of refi to pay off that second mortgage so that she's no longer in notice of trustee. Yeah, that's a great question, right? And this is a great example of why it's so important to have these conversations with your clients, right? You want to be having these conversations with your clients because it could be something really small where they think everything's going well, and all of a sudden they get triggered on a second loan, or they could have something that is not, where they're not covered by the moratorium, and now they are being affected by that piece as well. So it's just really important that we are having these conversations with our clients, that we are keeping posted on what's going on. A couple other things that I want you guys to be aware of that are not, it hasn't necessarily happened, but these are conversation points to have with your clients. We know that right now there is a proposal right? There is a proposal to offer a $15,000 first-time home buyer tax credit, which would be able to be accessed immediately by the buyer, serving as a form of down payment assistance. In addition, there is an effort to potentially reduce the MIP, and so monthly insurance premiums under the FHA as well, and to expand the FHA to big banks. So I want to put this in perspective. The last time we saw a major tax credit, right, like what is being proposed, that tax credit was less than $8,000, right? So $15,000 is a pretty big tax credit from what we're looking at, as well as that MIP being lowered could have a really big impact on your FHA borrowers. The other thing that they're looking at is a sort of rescue plan that would allocate a certain amount of money to help with rental utility assistance. So this is kind of what California is looking at using, where they're talking about utilizing some of these federal funds to create this rental relief program. What happens is the federal government, right, our government may allocate a certain amount of funds, and then statewide, the state is gonna have the access or the control over how those funds are utilized. That's why there's already been a little bit of pushback against what was discussed yesterday with not just the eviction moratorium, but the way that the relief program is designed, because it's going to fluctuate state by state in how these relief programs are actually going to have a big impact on the tenants as well as the landlords. So that's just something for us to keep an eye on as well. And then one of the things I mentioned last week is as we see any economic recovery. So I want you guys to understand the way mortgage rates work and why we've had such low interest rates, right? When the economy is struggling, the Federal Reserve buys up mortgage-backed securities, right? When they do that, the rate stays low. So this is kind of a really basic understanding of it. Or really base terms of explaining kind of the way this works. As the economy recovers, the need for the Federal Reserve to buy up these different mortgage-backed securities, it decreases. That puts an upward pressure on rates. So as we're seeing all of these different things come into effect, these tax credits, right, all of these different pieces that may happen, we will likely see rates rise. In fact, we saw interest rates begin to tick up a little bit within the past week, and yet refinancing incentives still remain strong, right? So we want to keep an eye on that, but I want you guys to kind of have an understanding of how that works, so that when you're talking to your clients about this, right? I know that we have limited inventory. I know some of them are like, hey, I want to wait for this, I want to wait for that. Now, might it make sense for somebody to wait to see if they're going to qualify for a $15,000 tax credit? Where might that make sense, right? Now, that might make sense for somebody that doesn't have cash on hand for down payment, right? Or for those pieces where they need a little bit more of this access. If they're able to access it right away for down payment assistance, then yeah, they might need that. But I want you guys to realize that as that happens, and as we wait for those things to happen, we may see rates begin to uptick a little bit, which means what? It just means that those some of that stuff that they might be getting up front might end up getting baked into their loan overall. So just important to kind of understand those things and kind of what we're anticipating coming down the pipeline on the market. I am going to continue to make sure that we are sharing a lot of these different updates as they're happening, because things are going to move quickly over the next couple of weeks. This is going to be really important for us to kind of keep an eye on, and then to realize that there's going to be some problem solving that comes up with different transactions like the one that Jen just mentioned as well. I see she doesn't qualify for traditional loan to refi, so looking to have a relative buy the home, that's plan B. Yeah, I'd say, yeah, that's unfortunate, right? It's with her being retired, that was the one thing I was concerned on not being able to do, a little bit of that refi. because of that there not being like an increase in the income or anything like that. Definitely, I would definitely see about, you know, seeing if there might be any other lender that maybe is not going to be as traditional. I see Ralph mention a portfolio lender might be an option, but yeah, that's definitely a little bit challenging. We may see too in this particular case, not where if a relative is interested in buying the home and maybe figuring out some type of payment option as well, where they do some type of where they do some type of financing back. Let's talk offline on that too, Jen, because there might be a couple there's kind of a couple things coming to mind, but that we're definitely at time today, and I went over a lot with you guys, so I wanted to, but I have a couple other things that are coming to mind on that as well. All right, guys, with that, a lot of information that we covered, right? These slides will be available for you on they're going to be on the site, so I'll make sure those get posted. There's a couple articles that I will share with you guys as well. A couple key things. Remember, the eviction moratorium is extended, but if you have any, you know, any tenants that you're also talking with about this, make sure they understand it. It is partially going to be at the discretion of the landlord if the landlord decides to participate in these rental subsidies. So just keep that in mind as well on these issues as they come up, and have the conversations with your clients now as it relates to the foreclosure moratorium, and really figuring out what their options are before they get pushed into a situation that they don't want to be in and makes things time sensitive, right? Like a notice of trustee sale, like when they start getting their NODs. And then if they do not have a federally backed mortgage, then that's a problem that needs to be solved sooner rather than later. With that, I hope you guys have an absolutely phenomenal rest of your day. A lot of information this morning, but I will see you guys soon. Bye, everyone.